Welcome, everyone, to another webinar from CoinDesk. Today, we're going to be focusing on the role of crypto derivatives in tomorrow's market. To give a bit of context, if you read CoinDesk pages these days, for example, it's story after story of institutions arriving and participating in this new asset class. And for years, it was about speculation on when these institutions would arrive. So we see a real transition just in the past few weeks. And if you need some confirmation of what's going on, we saw just this weekend where the creator of Ethereum ended up on the cover of Time magazine. And then there was some online discussion about it all and some things based on appearance, et cetera, et cetera. But Tom Brady came in, the star football player, and mentioned what was going on and threw some support behind, in the way, the industry. And it sort of is a bit about what we're talking about today, this cultural flippening, people who have seen this stuff happening for a long time and who are building products and services and are at a market that's actually reaching a certain maturity now. And we're going to talk about that maturity today by people who have been participating at all parts of the trade life cycle. So welcome, everyone. Welcome. Tim from CME. Nice to see you again, Tim.
Yeah, you too, Nolan. Thanks for having us today.
Yeah, what did you think about that Tom Brady moment? Did that register for you at all?
Yeah, I mean, I think it just, to your point, Nolan, it speaks to how pervasive in the everyday culture now crypto is becoming, and more people are adopting it, more and more people are utilizing it, and more people are still learning and trying to figure out what it means for them. So it's, I think it's only going to continue to increase in the cultural norms here these days.
And that's something we're going to be talking about today. It's alternative investment classes, market structure, products, and really how this industry has grown and matured. So I want to start with the discussion around market structure, really, because as we're talking about, the context is change. It looks like things are changing. Market is reaching a certain amount of maturity. And things look set to explode because everyone on this call anyway has been participating in for a while now and definitely understands from a certain perspective, what kind of maturity we're at. So let's begin a little bit by just talking about that market structure and just the opportunity that has arisen from an asset class that has sort of VC qualities that have gone into supporting it from the start, yet and all that price discovery, yet has this Wild West market. So Derek, I would like to start with you today because this is a part of the industry that I think someone like yourself has a lot of opportunity to play in. So I'd like you to share a bit of that context of where you find yourself in this market structure duality, where you started and how it's grown.
Yeah, thanks, Nolan. It's good to be here. Appreciate, CME and CoinDesk and everybody putting this together. Yeah, I think your categorization of you have on one end a lot of private equity or venture capital or what you might say is institutional money kind of in the truest sense. And then you still have a very undeveloped or Wild West type of token or coin market and cryptocurrencies and developing. And so it leaves a lot of opportunity that right in the middle, you think about how offshore, onshore, over the counter, all the functions that I think traditional investment banks have gotten to profit from in any developing asset. I think about high yield in the 80s. Like usually the way it happens is some of the banks get basically almost like a monopoly on the product. And then it gets big enough that then exchanges like CME and maybe CBOE and stuff all come out with either options or futures or derivatives. And then institutions start trading that, and the risk transfer market starts this really nice virtuous cycle of you have physical securities, you have them hedgeable, you have the derivatives. And so then you end up with billions of dollars in derivatives, if not trillions, and the cash market is very profitable and everything like that. But you can throw all that out the window now. Basically, a bunch of people got together, started their own financial ecosystem, and now all the money on the private equity side said, look, there need to be real services here. There's incredible cost of capital. There's not a lot of capital flowing in to fund the Wild West side, even though there's no problem getting money to start your own, small company that claims to be in crypto, but not trade crypto, right? It's kind of like we're building a system for it, but we're not really in it. And so that's where the opportunity lies. And we talk to a lot of clients about how do we get capital into the market? How do we partner with guys like Wedbush, who we'll talk about, to get that funding, to basically profit from this Wild West, and where people still need to lay off risk, they still need to transfer, they still need to manage their book. And for all of the institutions to get involved, that has to exist, right? You can't be the investment banks and just you have to warehouse the risk somewhere. And so that's where we're excited, and we'll talk a little bit more about it. But it's this bifurcated world has really created a unique situation where nobody has a monopoly on the product. And so that allows a lot of different entry points, and you can kind of pick the way you want to play it, if not multiple ways.
So you mentioned Michael O'Callaghan from Wedbush just a minute ago, and how that opportunity does require you to, let's say, team up, work with other marketplace participants to sort of squeeze out what financial relationships are available in this system. So could you just, Michael, describe how you participate in that way, so we can get a picture of the other side of that?
Sure, and thanks, Nolan, and thank you everybody for the invite today. Wedbush is certainly delighted to be here. So, it's interesting. We're already referring to the digital asset industry and the opportunity to trade it as a new asset class. But in 2017, when the first futures were being launched, and the CME were certainly requesting their clearing members to participate in clearing up this new product. So in December of 2017, all that we were talking about from the brokerage perspective was there's a new product available for that clients wish to trade. And clearly, the way the market has developed, it is its assets class. And so that's kind of been an interesting ride, to watch that develop, and how the conversation changes a little bit around the table, just from internally at a brokerage firm, that, hey, this is not just a one contract that a client trades. There's more opportunity here. And as far as like a structure from a brokerage perspective, it's the opportunity to build out something that looks more like prime brokerage, traditional prime brokerage off the equity side, than just clearing a contract on any one particular exchange. So, and that opportunity is, continues to develop, and we recognize that, and we investigate and we brainstorm all the time.
What pieces would you say, from your perspective now, are still missing from the full prime brokerage experience out there?
Well, I think the whole financing component has yet to play out, and greatly due to the regulatory component, right? There's a lot more that will happen. So an easy example would be a very easy example, which we'll certainly touch on later in the conversation, but is collateral. So digital asset, not necessarily future, but a digital asset as collateral to be provided to, let's say, at an exchange as collateral for their margin requirements, or that same collateral, is being used, let's say, in the spot market today for financing arrangements, with digital specific banks. But certainly the financing angle will be one component that is a lot has to play out, and it's mainly due to what the regulators are going to allow us all to do. Today, a US registered FCM is not permitted to lend to any client for initial margin requirement, but that financing is a component of the prime services that is yet to play out.
And when I hear that sort of idea of using, how price discovery would function within market structures, how would you walk a client through that the way you just described it? Because you said you still are getting a lot of, let's call them, still people coming in to inquire. And I'm going to turn this question over to the Jane Street folks and Eric. how do you walk within this changing market structure, this cost of capital discussion? Because the regulatory piece remains an obstacle, I think, that a lot of people have in setting up some benchmarks for themselves.
Yeah, the cost of capital is definitely an interesting question. Just going back a few years, cost of capital had been extremely high. You'd have to put dollars and or crypto on every single crypto exchange you wanted to trade on, and moving between them was difficult, especially dollars, and sometimes as well for crypto. There'd be delays, there'd be issues, things like that. So I liked how the other panelists touched on the CME futures being among the first big market structure innovation, where it allowed FCMs and other participants to kind of start the crypto market towards looking more like traditional finance somewhat. And along with that is better cost of capital. I still think we have a ways to go, but there are it's a problem that's being worked on by a bunch of companies, and as well as networks improve between participants, some of these costs of capital can be reduced. But yeah, there's a floor right now, I think, given regulation and just kind of the way a lot of the crypto exchanges especially are fragmented.
And what Mike was mentioning earlier about that collateralization piece and its capacity to change the cost of capital, because you all of a sudden would be able to collateralize a digital asset in a different way. Do you see that psychology changing at all? Because that's a big piece of the retail momentum, that Bitcoin is the greatest collateral in the world. Is that a question that or a conversation that comes up regularly, this treatment of it in this context?
Yeah, I think so. I think as Bitcoin, especially it being around the longest and is seen as the kind of most established of all of the cryptocurrencies, I think seems most likely to be able to be used as collateral. There, El Salvador's thing about listing bonds, Bitcoin, you can take loans out with Bitcoin, and you get the best rates with Bitcoin collateral, rather than if you're trying to borrow against some other cryptocurrency as your collateral, with some of these crypto native borrowing and lending firms.
I could also throw in just which was not broadly realized. The brokers are certainly very aware, just as we are, but the cost of capital conversation has parallel requirements or influences, shall we say. As a US registered FCM, there is a regulatory capital requirement that every clearing firm has to take. And that would be different from Eric's description, certainly the cost of capital, which ultimately will always roll down to a client anyway. But the cost of capital and how a trader, regardless of their profile, engage in the market and how they manage their money is one context, but then the context specifically for the haircuts that an FCM, a clearing firm, has to take directly related to a regulatory capital requirement of an FCM in support of clients who trade in any particular market.
You mentioned that this can happen regardless of, let's say, persona. Now, that's one of the neat things about the venues and their expanded price discovery products, and I'll invite Tim to sort of talk a bit about this market structure evolution, because we've seen the products available at your venue just explode. Is this customer demand? Is it market demand? Just as far as so much activity in around the world and interest. So briefly, just describe this evolution of market demand and a bit more about that opportunity by this duality that we've been talking about.
Yeah, I think it's a great question. So when we look at it, I think even going back to the point that we were making a few minutes ago, is you do have kind of this reverse market structure development where it's largely being driven by individuals, new trading firms, crypto native firms, And then you have now the wholesale market kind of catching up. More asset managers are getting involved, even some pension plans are getting involved. And you're seeing now people figuring out, how can I use crypto, or how can I offer crypto through the same way I've offered traditional products for the last several decades or even centuries, right? So you have kind of a reverse development versus some of the traditional markets that have developed. And I think that's great to play out for the price discovery process and the risk transfer process, because we've had institutional flow for a long time in our market to CME. Our product, our position has always been the regulated venue offering regulated products, both as a hedge mechanism or an access product, right? If you wanted to get involved or invest in crypto, but didn't want to handle the digital assets themselves, you could trade the financially settled futures at CME in a regulated, transparent, and trusted manner. So that certainly brought a lot of that institutional flow to the exchange. It's continuing to increase, but also what's exciting, almost what's a requisite for the or an efficient price discovery process, is you need multiple of these customer personas and personalities to meet in the marketplace. So the fact that we have miners, crypto native trading firms, institutions, hedge funds, retail, and now even the banks are getting involved. You're having these personas continue to show up to the market, which is adding richness to that price discovery process in terms of how fulsome that process is. That you have people fundamentally disagreeing over the direction of these assets, or have different motivations in terms of what they're hedging, or are they just allocating investments? They have new money in, so they have to allocate. Some miners might be hedging further out the curve, or they might be using options and hedging. Right? So you now have all of these flavors kind of manifesting in the price discovery process, which only increases the efficiency. And then when you look broadly outside of the CME group, this interrelatedness between the various markets is only continuing to increase, which is increasing the velocity of the risk transfer process in a good way. And you now have the advent of futures-based ETFs in the US market. You have structured products and ETFs overseas. You have the spot markets. You have the banks starting to figure out the OTC market, the options market. These are all great developments, and I continue to expect all of that interrelatedness will a lot of times find its way back into the futures market or the derivatives market, which often can grow larger than the underlying markets because of the price efficiency. And to Mike's point, the benefits of central clearing, what Eric was saying around the capital efficiency that futures can provide, helps the ecosystem continue to grow. So excited to see what the next few months and years have in store for us, as well as more of these products come online and more of these institutions figure out what it means or a way for them to offer crypto the way they offer their other products.
Yeah, and I would like to ask Derek, just touching on that, assigning a seat at that risk transfer process. And are there clients who arrive and just say, well, I don't know how to participate as far as hedging this risk, and then you really have to walk them through every product, or do people come with an idea of a strategy that they would like to see? What's how does that break down for you, and how do you basically diagnose or categorize that persona and sort of match them with a strategy?
Yeah, it's a little, it's not like we have a big menu, because the blessing and the curse, to use the phrase, is this decentralization, right? So it's really more, we try to ask a binary question, right? It's kind of like yes or no questions, because you get so far down the rabbit hole of, should I be in multiple coins? Should I be trading different, so we want to solve a few problems. One, let's just get with the CME and use let's take the custody, let's take, a lot of the questions about the structure and sanctity of getting into the space, because a lot of clients that are asking the questions already have either dipped their toe in their own Coinbase account, or they've said, well, I traded this, or I own it personally, but my board won't own it yet. Or they're already in venture capital and private equity, and they're saying, we've seen venture capital basically have long positions in crypto just as, a way to keep capital invested, because that's their mandate. So it's a weird kind of conversation. So we simplify it to, it's literally, do you believe, everybody kind of believes in the space, first off, and then it's a get rich or stay rich kind of question. Do you want the right tail and just you're trying to be long and strong in futures and trade it and go with the momentum, or have some kind of strategy that really is kind of, again, the get rich, even though a lot of these coins and tokens have gone up so much anyway? Or is it more the stay rich type strategy where you're like, let's turn this thing into, make it look more like a bond or more consistent payoff. Let's vol harvest or data harvest, whatever you want to call it. I think there's another a crypto term that people are using on kind of the yield, what's basically traditional vol harvesting, but
farming. Yeah.
Farming. Thank you. So once you decide kind of what side of that ledger you're on, then we can really dive in and either you're in futures or options or things like that. But the huge leap is that you actually have big, to Tim's point, you have big derivative, CME bought in early and said, look, we're going to have this. And you needed the cart before the horse. You just did, because nobody is going to get into the business big until they can lay off the risk or manage some of these, and pricing vol in particular is more important than price discovery in my world. Like when you have such an unstable return distribution, having multiple sources, Deribit, LedgerX, CME, different tranches of size too. You now have large contracts and small option contracts. So I have 2 implied vol surfaces. All of that is more of a risk discovery, not just price. Now they're one and the same, so I don't want to sound too interchangeable, but that's just, if not more important when you talk to, because you're never going to have margin with Wedbush if they can't model this, the dynamic CME span or what have you. So all of that is so interrelated. But to get back to your question, we keep it very simple. Like, what is the goal here? If you're already in it long, then you don't want more of the same, or are you not in it at all? And we're trying to get you a nice, easy vanilla ice cream approach.
So Mike, would you say that it's client demand for sure? It's as simple as get rich, stay rich, etc. But that simplifying really does do the trick as far as understanding that risk transfer process here, and that it's so easy to overcomplicate it for clients. Is it really just the situation where you can flatten it for them like this?
So I think I'm going to answer your question just from a different angle. So when we enter into our first conversation with a new prospect or new client, just getting an idea of the profile of activity. So given who we have involved here today, so there's a profile of professional money management, principal trading groups, and the way I think about it, like they're the 2 key ones that contribute to the core activity that we see. However, the speculator side, being category number 3, I think really, that's my own opinion, is really kind of only come into its own in the future space since CME launching, say, the micro contracts, right? So you have that retail component, and as history has shown for the CME, when they launch smaller contracts, it just explodes in liquidity and transform in a positive way. So when we sit down, we have a conversation, just kind of understanding what the client is looking to achieve. So if it's a professional money manager, we know that, of course, they're after performance, but they are going to have a documented target of trading activity, how they go about it, and what that is going to look like. So it's all very clear because it's required in their disclosure docs. And on the principal trading side, it's also a very comfortable conversation because like firms like Eric's, will play at a level where they have a commitment to be involved in how they are involved at the exchange level, say in market maker programs, liquidity providers. There's a structure there that we can all kind of talk about and be somewhat transparent. None of these clients are going to tell you 100% of what they do because they, that's their proprietary business. But the structure around the professional money management and the professional participant that is a market maker or liquidity provider is very comfort level. The retail side, let's say all the online brokers are very busy generating, has been successful, but it's a different conversation than it is with the professional and principal traders. So answering your question from a different angle, but hopefully that.
Yeah, but what I'm, the thing that it makes me think of, and tell me if I'm correct about this, is that having that big retail base now does, because of the added component of price discovery, participation, interest, broad interest, is it correct to sort of categorize it as, it looks like everyone still buckets cryptocurrencies, Bitcoin, as alternative investments, just as far as the asset class. But with this broad participation, is that necessary for its evolution into something totally unique, which we can all sort of see already? But is this micro futures part, retail participation, that new exposure really the required momentum to push it in that direction?
Yeah, I think so, but I also think that is already proving out from what we see in the activity, even just on the CME. So yes, I think that precisely is playing out right now, as it has done for other contracts, even at the CME over the probably more recent years, kind of within the last 5 years. And maybe Tim would agree, but yes, I think so.
I would, Nolan, if I could add on to that, and to be a little controversial here, I think it's wrong to call it retail. I think if you talk about a decentralized trading world, I think there's no reason that a 28-year-old sitting in Hong Kong or Europe should be considered any different than a 28-year-old trader sitting on Goldman's desk. Or not to pick on Goldman, but just because there's not a horde of them on Wall Street trading, day trading. When I got out of school in 1998, I mean, it was like, oh, you could go, I was an engineer and they wanted me to sit in some trade oil and stock and my own P&L. And if I did well, I did. All that's existed for decades, and now we kind of call it retail. Now there's a retail component, no question. I have, my tiny bit of long Bitcoin on a platform, but I do think a lot of those guys and gals and people that are trading, I don't know that I would consider them retail. It's almost like imagining the SPX option floor, because it's the only one that still probably has an open outcry pit. But I just imagine all these guys around the world, or people around the world, that I wouldn't call retail. They may be small money, but they're not trading it like retail. And that's, I think, the difference to Mike's point. He has a set, he's kind of B2C or B2B, B to business. He plugs into all these guys that earn, people, and we're kind of B2C, right? I talk to institutions and retail specifically, but when everybody keeps saying the retail and crypto, and I just think it's a little of a misnomer that it's not all retail. And it's not like my dad trading IBM and Apple daily. It's some people that really understand market dynamics and developing this market.
Yeah, I think that I kind of would agree with both Mike and Derek. And I think what's interesting is, and I think Derek, what you're talking about is it's more the motivation of that trading personality, kind of like what I was talking about before. And you're having people who are not only genuinely curious, but understand the entirety of the crypto ecosystem and the fundamental protocols and the networks that some of these tokens are powering. And you have highly informed flow from these individuals, whether they're trading in their own account or they're trading for a professional account or a trading firm. And I think what's interesting, it's that motivation to cross the bid-ask spread, so to speak. They're the ones that are coming in with a trade to do. They're not the passive liquidity provider. They're not necessarily saying, I'm going to put my order out there and see what happens. They are a much more convicted, I feel like, type of trade flow, where they're coming in to allocate, or they're hedging something specifically, or they're bullish on the crypto itself. And we're seeing that in Bitcoin and Ether at CME. And I think, to Mike's point, it's certainly the advent of micro contracts has really empowered the marketplace as a whole, because while that has brought in the active individual trader, regardless of where their seat is, it's also being used by institutions, because now they could kind of scale up or down a little bit easier. They could monetize down to the dollar. They're not having to allocate in $200,000, $300,000 clips. And that's some of the motivation why we're launching the micro options next week. It's something that we've had a hard time with the larger option contracts getting adopted. So we see the need for that smaller size contract. So why we're launching micro Ether and Bitcoin next week on the option side. We're also introducing Monday, Wednesday, and Friday contracts, so more like the weekly and daily flavors, because these are what people want. They want that short-term access. They want the smaller size product. They want to be in the market throughout the day. So while some people are using the larger contracts to kind of set it and forget it and allocate, and it's an access trade, The micros are just a much more nimble product, which I think brings in that slightly more aggressive or convicted trade flow, which is certainly helpful for the product growth and the risk transfer process.
Yeah, what Derek was mentioning makes me think of Peter Brandt, who I think is probably one of the largest users of your platform that I know. And Peter has always talked about how that retail side, he wouldn't even call it that. People have learned how to, let's say, take a punch, throw a punch, duck a punch, hit back, or whatever other analogy you want to use. But it definitely reminds me that the ability to understand these markets has sort of expanded just because there's this great interest. And these folks don't need to worry about classifying it as a different asset class, or it's just what they know. And I think, Eric, you get to enjoy that same freedom. You get to, participate in the markets that you see have the most interest as a prop trading firm. So just describe that, nevertheless, that evolution of the asset class itself, because I think it does, you get to be at the forefront of where the needle is getting pushed.
Yeah, so as liquidity providers, we definitely kind of try to make markets and provide liquidity in areas where there's a lot of trading, right? That's where prices can get out of line. That's where there's opportunity for us, as well as we get to provide a benefit to the market. So just even the growth from Jane Street's crypto desk, I think it mirrors the growth of the industry in general, especially at least on the traditional side. We started spot, then derivatives started coming up, then now options have become more popular, as well as new bespoke products that banks may be putting out, similar to NDFs, things like that. And so our desk has grown in a way similar to the way our commodities desk may be, where it's gold is something that trades in a similar way. There's spot, there's options, there's ETFs, there's futures, and except for the fact that crypto, you can just do a lot more with it. So it's a much more exciting, I think, area, in my opinion, than something like gold. But I think the growth of it has mirrored that. And, except there's this whole new wing about, trading, DeFi trading, things like that, that may be outside of the normal scope of the way gold or other currencies and commodities might trade. So, we're kind of going to where we see trading as much as we possibly can.
It'll be neat to see a prop trading firm participate in an automated market maker sometime. That would be real fun to see on chain anyway. I do want to steer the conversation a bit to, we've seen the White House come up with its draft plan. We don't need to get into the details, but it looks like there is a certain amount of regulation coming and tax rules that might be attendant to that regulation. It looks like every department has been directed to come up with a plan. So no need to speculate on those kinds of specifics and where it'll go, but how many of these events will affect your end of the industry? Let's say we see a lot of nervousness amongst let's say the religious around Bitcoin and cryptocurrencies. But is that a piece that has caught much attention in this side of the market? And I'll ask Derek first.
I think it's top of mind for a lot, depending on where you want. I mean, institutions less so, but as you go on down to okay, what are my implications and how do I, it's like eventually, depending on the rules, like having concentrated stock positions, how am I going to manage around that? Can I use some futures or derivatives or what? So, but I don't think it's we kind of have a bunch of catchphrases, but we think regulation is going to be a real revelation basically here in the States. And even when we talk about if there's central bank digital currencies or what have you, all of that is just going to help winnow down the field, right? And we can all say what we think are going to be winners. I think there's, just like technology, you're going to have FANG, you're going to have like 5 or 6 of these big things that service most of everything. So the regulations, as you said, we probably not worth speculating, but that's actually, going slow has been the best thing that the Fed and US could do. Just, there was no urgency. Let some of this stuff, learn as you go retrieve or recapture some lost Bitcoin, show that this can be done. Don't worry about illicit things. So I think the taxes are kind of a given. Nobody's going to be surprised that you're not going to be able to make tax-free profits in some global asset. I mean, I think that would be pie in the sky type thinking. So that, and topic for this call, it just feeds back into why we like some of the derivatives, because you do get 1256 treatment. It's very well defined. You get 60-40 long-term. For those of you who don't know what 1256 is, 60-40 long-term, short-term capital gains treatment. You do have mark-to-market rules, but that's very competitive, right? I mean, depending on what you're comparing it to. So all of that, I would say, is kind of academic at this point. That's why I don't think it makes, if anything, going slow is really going to do us a big service, and they haven't been rash and they haven't been reactionary. And in government, that's what you want. You don't want any change, and slow is better. So let me not take any more airtime, but yeah, we don't talk to anybody who is like, oh, but what happens when regulation comes? That it just doesn't happen.
Yeah, that's sort of my what I felt like was the situation, but it's good to hear it from the folks who have these conversations, because we've seen this influx sort of add unique capacity for the market to evolve and for more of these personas to enter. And had regulation come too early, could have missed out on a whole bunch of people coming in. So when you see these new micro options products that are coming out, are there any new personas you could see coming through the door because of this, Tim? Is this sort of an invitation to someone who's still missing, or is this just another tool for, basically everyone's arrived and it's a little more stuff to do?
No, I certainly think it's going to attract even more users, right? So if you look at some of the other traditional asset classes, there are certain strategies and traders and firms that almost exclusively deploy option strategies. So this will give them another tool in the toolbox. So we're expecting kind of new personas, new entrants to the market, which I think will not only be beneficial for the micro-sized options, but also then they're going to hedge in the futures market, or they may deploy strategies against the underlying spot market. They may trade against platforms such as Deribit out there. So I think we're going to see more firms and individuals coming online, because like you see in other parts of the market, they're almost exclusively trading the vol, or they're systematically trading options, or they are using options for either access or managing a very specific risk around price, which we know there's always lots of interest in some of the, we kind of refer to them as like the optical strikes. Like a lot of people like to play the 100,000 strike in Bitcoin out there just because it's an interesting trade. So yeah, I think we're going to see a lot of folks new to the market, and based on the feedback we've had to date, I think we're in a much better spot with this offering than we are with the 5x BTC options that we have at CME. Because those are only month end, they line up to futures, and these options will actually be, again, Monday, Wednesday, Friday. We'll have 4 Fridays at a time plus the month end contracts. So like options on futures, in general, it's a seamless delta event at expiration. So if this option finishes in the money, you're going to take possession of the future in a seamless fashion. So it also removes some of that replacement element in some of the other option strategies where there's no gap. If you're trading a certain product and you're in the money, and you have to kind of hedge your underlying spot asset somewhere, or liquidate it or replace it. This is easy. It's all the futures. It's seamless, and at one exchange. So I think a lot of people the feedback they're providing is they're excited about deploying those specific option strategies, which I think will be great for the market.
So it's kind of like a feature parity thing, there's waiting for these other features to join in. And now that they're here, you have the full suite, just like you would for, any other more established.
That's right.
I was also just going to throw in, when you made a reference to who has arrived, in our space, as a broker, we watch the other kind of brokerage participants also, and kind of recently between crypto.com, FTX, and Coinbase, and what they are doing, and we listen to how they speak in the public space and refer to the very impressive multi-millions of, whether they're actual accounts or user IDs, but they have a database of users that are in some way active on their platform. And that population is they're pretty impressive numbers. And the way that FTX, Crypto.com, and Coinbase are choosing to get into the regulated space, interestingly, as brokers, as opposed to as an exchange, futures exchange meaning. So, but they bring that population with them. And that's a population, many of which have been trading spot Bitcoin for years. So when it comes to price discovery, this is a population who has been performing and managing price discovery for years before the futures contract was even launched. And they are here with an appetite, looking for more. And there's just a tremendous opportunity and kind of a real shot in the arm for a traditional broker, such as an FCM like ourselves.
I in a former life helped Kraken set up the US bank. So, have a big focus and one product, the proof of reserves product, which along the lines of what you guys discussed, this collateralization piece. I always thought that was the sort of product that would be a beacon to help, conjure support, confidence in the market. If you know that an exchange has X amount of coins on hand. And it brings me up to a question where I do want to talk about, what product offering would really be like, I'm mentioning from a purely banking point of view, proof of reserves as a product that I think would be a huge innovation and a welcome addition to the market. Is there something out there that you guys see would be like a real flashing red light as far as maturity of the industry, like a real progression, sort of a benchmark where you'd say, now that this product is here, it's having this brand new effect on the future? So, Eric, someone who is looking at this trading stuff tangibly yourself, is there something out there like that?
Yeah, in my mind, to me, it's the growth of ETFs. I might be a bit biased because Jane Street is one of the leaders in the ETF space, but just the way that the structure of ETFs and that you can design them in a way to invest in certain ways and combine different things in an ETF and have an ETF maybe do staking, offer, similar to the way some ETFs, current ETFs like, invest in dividend companies. It can allow for asset managers and just kind of normal participants, even smaller participants like people, invest in a much more customized and efficient way. So in my mind, once I see that and a large growth of ETFs, I see large investment in the space, especially because it could be so tailored to individuals' needs or institutions' needs.
And Tim, from someone who's got a regular clip of products coming out, is there something along the lines of an ETF or in the banking sector, like I mentioned, a proof of reserves as sort of a beacon to highlight a progression of an industry?
Yeah, and I also completely agree with Eric. I think the innovation that's existed in the ETF space historically, right? My background is equities before joining the exchange, so I think that's an impressive roadmap. You can certainly develop a lot more strategies, right, that are bespoke or tailored or have serve different facets of the market that things that futures can't. So I think it's always a growth versus growth story for ETFs. So we're excited about that. I hope more ETFs come online in the ecosystem generally. So I enthusiastically endorse Eric's viewpoint. I think from my perspective, the other thing though that I think would be kind of that watershed moment is the real proliferation of OTC products by the banks. I think that's kind of what's missing in the institutional landscape. We're starting to get there. There's a lot of chatter about NDFs. We're kind of looking at that at the CME front with our EBS platform. We're looking at how can we work with banks such that they could build these OTC desks, that they could provide that wholesale service that they do for other asset classes, whether it's swaps, options, forwards. I think structured notes, certificates, like all of these things that they do well. I think that would be a real strong statement of maturation and longer term innovation, such that they could service all their clients. And all of that will kind of work back into the spot markets, the futures markets, the ETF markets. So I think for me, it's can we get all of the big banks, the traditional banks, to have those OTC crypto desks with products out there, hedging with futures and just recycling risk. To me, I think that would be a real point of evolution, success,
Yeah, I've
success.
never thought about it, but you're totally right. That's a very underdeveloped section. It looks, dwarfed by where you'd expect it to be based on maturity across the industry. So very, very interesting.
Yeah, I would. Yeah, sorry, Nolan. I was just going to jump in. So I don't think it's a watershed. The most interesting thing for me is at what point does the layering start to detract from the whole blockchain ledger, right? It's like saying, okay, like the idea of a centrally cleared clearinghouse that goes to the ledger, like you actually settle on blockchain's ledger, or excuse me, like Bitcoin's blockchain, rather than have an intermediary. And that's a really interesting, I think, long-term question in my mind of like, which way does that go? Do we get to the point where the whole uniqueness of the blockchain or cryptocurrency is that it can be somewhat independent? And are we going to build things that kind of go directly to the ledger? Now that has transactions, expenses, and stuff like that. But then there's this whole middleware that, we keep stacking on top of it. So I don't know which way it goes, right? Like the real benefit, do we then have kind of a source where you're saying, look, when I get a futures contract, I want it to just instantaneously. That's why you wrap things in Ethereum, you wrap coins and stable coins, and there's all sorts of things going back to that. It's not a retail investor. There's a lot of people out there doing some really cool things, making their own structured notes, making their own almost OTC contracts that just automatically settle in the decentralized world. So
their own nodes to settle.
And so
front run.
I think it's going to be parallel for a while because but that's the big watershed for me. Like, how much of this do we start to really move away from calling Goldman or Morgan Stanley or JP Morgan and be like, can I get a swap on these two pairwise cryptocurrencies, rather than having a service that's almost straight through for Goldman? Now they may clip their toll, but it's going to happen on the ledger, not just, somebody's, accounting system that they're the address for that coin, but they know I own it versus, Tim. So that's my big interest of like, how much do we start to really move into a decentralized world, even under regulation?
So how much the tech can actually scale reliably in a way that, permeates confidence so that some form of new transaction types become more normal.
Yeah, I mean, because the whole part of the old argument is this can live in cold storage. It can be, your gold sitting in Switzerland and stuff like that. So if you're an institution, you start to say, well, it's just another OTC contract with Goldman on some esoteric asset. Is that really its own asset class, versus saying, no, we own it outright and it has its own market, if you will. Now, I think that's parallel. I think they both exist, but I'm interested in this other one developing, not just more financial products as backing it. Because, and long story short, I'm in the risk transfer. I want this parallel universe because eventually risk always gets laid off.
In a new era.
Yeah.
Pardon me, Mike. You're the last one to not give us an indication on the new products and flashing lights to mark that change.
Sorry, who was that for?
That was for you, Mike.
Okay. Listen, we're a broker. Our needs are kind of basic. We just need to be able to clear a listed futures product. But what makes a difference, and it's not what you're looking for, which is name a product that makes sense and what will be a game changer. The game changer, which we did allude to earlier in the conversation, it's the regulatory capital requirements are not likely to change. The regulatory capital requirements are actually the same percentage on a digital asset future versus a non-digital asset future. It's the same. It just so happens that the exchange minimum margin requirements are substantially higher for a digital asset future. If the margin requirements at the exchange level were altered more favorably, that would be a game changer all the way down from us as a brokerage firm, because it affects our regulatory capital requirement, but then all the way down, cost of capital conversation, all the way down to the trader, regardless of their profile. That would be a game changer for us. And then coupled also, which we refer to, which is just being able to use a digital asset as collateral, being able to post it at the exchange level for collateral on behalf of the client activity. And then for us as a brokerage firm, figuring out, in line with regulation, how we can accept posting of that. So a relationship with a custodian, or whatever the mechanism will be when it does happen, because it will happen. So not a product as such, but a structure of how it would be game changing.
Excellent. Well, the next time we talk, maybe some of these game-changing products and advancements will have arrived. Tim, thank you for helping us put this together. Any last words for our audience?
No, just want to thank everyone for tuning in today. And Eric, Mike, and Derek, it's been great talking with you, and Nolan, great to join you again. And just just really appreciate the opportunity to speak today, and just looking forward to seeing how some of these products and thoughts evolve over the next coming months and years. It's been an exciting ride to date, and really excited about what the future holds.
Thanks a ton,
Yes.
Tim.
Thank you for the invite. Thank you.
Thank you.
Everyone, thank you for tuning in. Join us next time on CoinDesk for another webinar. For me, Nolan Bowerly, your host, that's a wrap. See you next time.